Following a 16% decline in the second quarter, global equities saw successive peak-to-trough movements of up 11, down 9, up 5, and down 12% during the past 3 months, ultimately registering a decline of 6.5% in dollars. Persistently high inflation and the collective resolve of global central bankers to get ahead of the curve on interest rates really resulted in the broad selling pressure that we saw over the past 3 months. Cash was the only asset class that provided positive returns in dollars, while diversification proved pretty futile, with asset class and intra-stock correlations spiking. Dollar strength was a key feature during the quarter, with a broad index of the dollar strength on a trade-weighted basis gaining 7% during the 3 months. And this also undermined the performance of sort of key areas of the equity market, such as emerging markets and also the FTSE 100, both of those indices declining more than 12.5% during the 3 months, while the rand also saw significant selling pressure, declining 11% during the quarter. Against this backdrop, the Vunani Global Macro Fund delivered a positive return in rands of 4.2%, although that was more or less in line with the MSCI World Index and modestly below the fund's composite benchmark. Measured against peers, however, the fund performance was quite strong, comfortably in the top quartile against the global multi-asset flexible peers tracked by MoneyMate, which delivered a return in rands of 2.2%. Higher cash balances held overwhelmingly in short duration US Treasury bills, as well as our decision to maintain a modest underweight and at the maximum a neutral position in equities proved to be the correct strategy, while equity selection detracted slightly from returns, about 21 basis points, largely owing to our decision not to have any exposure to large cap stocks such as Apple and Tesla, which outperformed during the quarter. Key contributors to performance during the quarter came from PayPal and TransDigm, as well as certain US consumer names such as Amazon and Starbucks. In terms of the outlook for the fund over the remaining part of 2022 and into 2023, we would have some concerns around the dependence on a very narrow group of sectors for the broad market's earnings growth, particularly the energy sector. And for that reason, we've continued the strategy which we sort of communicated at the last quarterly report to diversify the fund's holdings into more durable areas of the market, while at the same time reducing the beta within the portfolio, as well as the concentrated nature of the fund's tracking area. In other words, the fund is far less reliant on a narrow group of companies to deliver the outperformance.